I think it's 1 minute past 10. I think it's better for us to start on time, and people can join us as they start logging in. Good morning and welcome to the second Bowman's Budget Speech Analysis webinar. My name is Yasmeen Suliman. I'm a tax partner at Bowman's. I'm a chartered accountant by profession. When I first joined Bowman's just over 3 years ago, I discovered that Bowman's employed many CAs. And my first thought was, well, what a progressive law firm, only to realize later that CA in the law firm environment actually means candidate attorney. Needless to say, I stopped using the CA designation very quickly within the firm. Before I introduce our first speaker, I would like to run through a few housekeeping items. And I hope that these housekeeping items will enhance the webinar experience for you. Firstly, as participants, you are automatically muted and the chat functionality has been disabled. Should you have any questions, please post it in the Q&A function at the bottom of your screen. Your questions will be submitted to my colleague Anushka Tiradari, who will collate them and pose them to the panelists. We will select a few questions to discuss at an appropriate time during the webinar, likely towards the end of the presentations. Unfortunately, we won't be providing any written responses to any of the questions. The webinar is being recorded and a copy will be made available on our website a bit later at www.bowmanslaw.com. With regard to those attendees that require CPD attendance certificates, we will be issuing these certificates after the event. And these will be emailed to you. If you don't receive them within a month, so by the end of March, please do contact us and we will provide that to you. And now it gives me great pleasure to introduce our first speaker, Michael Hewson. Michael is an economist who founded Graphene Economics in 2017 with a vision of creating a specialist economics focused African transfer pricing firm. In 2019, the company was recognized by the International Tax Review as a Tier 1 transfer pricing firm in South Africa. In 2021, the International Tax Review recognized Graphene Economics as the South African transfer pricing firm of the year. A remarkable accolade for a firm that has been in existence for only 5 years. And I have to say, having worked with Michael, that accolade is well deserved. Michael will be presenting on the macroeconomic impact of the budget. Once Michael is done, I will take you through the tax proposals. So without further delay, I will hand you over to Michael.
Good morning, Yasmeen, and good morning to everyone who's joining us today. I'd like to start by just saying a big thank you to Yasmeen and to the partners and the executives at Bowman's for the invitation to join you today. I've had the privilege of sharing some thoughts over the last couple of years, post-budget speech. And it strikes me that for the last couple of years, at this time of year, there's been a looming crisis that we've been facing as a country, and also a crisis that's emerged a few months later. 2 years ago, it was the looming Moody's downgrade. Shortly thereafter, a month in fact thereafter, we went into hard lockdown as a country. Last year, while the pandemic was well underway, we had the unexpected July unrest that we experienced during the year. This year, we still have all the uncertainty regarding the COVID pandemic. But just today, we all heard the terrible news about the events unfolding in Ukraine. That is undoubtedly going to have a significant impact on anything we discuss on the next several months and then a period of time affecting our businesses, our country, and the global economy. So what I'd like to do today is, and I just need to share my screen. There we are. We're going to be looking at 2022. How will South Africa emerge from one of the biggest shocks in the past 100 years? So where we find ourselves is at a point where we need to be asking ourselves, where are we and where are we headed? We're going to start by looking at where we are as a country. We will then have a high-level look at the budget speech from the Minister of Finance yesterday. We're going to look at the economic and the expenditure side, and Yasmeen will unpack all of the tax proposals a little bit later. Finally, we're going to look at some of the really big, significant global trends that are impacting our businesses and our economy. And they are very likely to impact where we are headed in the next several years. So let's start by covering an item that's been consuming our lives for the past 2.5 years, which is, of course, COVID. Now, what you can see here is that there are signs that the impact of the pandemic is starting to dissipate. We see this in a number of different areas, and this is driven quite largely as the vaccine has been rolled out in many parts of the world. So I've got 3 snapshots here. Michael Rudnicki, put the first one up just for you. Crowd attendance at Manchester United games. You can see how it basically went to 0 in the 2020-2021 period. 21-22, it bounced back really considerably, which is really positive. I must point out, Michael, that I showed this graph to a friend, and he pointed out that next year the numbers are likely to be right down for Man United games, but that's got nothing to do with the pandemic. Moving on swiftly, and a couple of other indicators are the number of flights worldwide. That was hit really hard. That's a global indicator. Restaurant and beverage income in South Africa, that was also hit really hard. Both, if we look at the worldwide indicator of flights and beverage and restaurant indicators, they have come back quite strongly, but they are still below the highs of pre-pandemic. Another indicator is if we have a look at the number of cases, daily new cases with each wave of the pandemic. So what you can see on the left-hand side is the various waves highlighted in gray and the Omicron wave highlighted in blue. It's quite staggering how there was a very sharp increase in the number of daily new cases of Omicron over the December, January, early February period. On the right-hand side, however, we see the daily new deaths. And what is really promising on this one is that despite the significant spike in the number of daily new cases, the number of daily deaths has fallen quite considerably. Another interesting observation on these particular graphs is the fact that we've got a greater spacing out of the periods between the waves. So while there is some good news in terms of the dissipating impact of COVID, it's still going to be around and impacting us for quite a while to come. But I think it's really important to take stock of the longer-term impact of COVID-19. That's brought some permanent changes to the way that we conduct ourselves in certain particular ways. And this graph, which was produced by the World Economic Forum in their Global Risk Report in 2022, this highlights the risks that have increased the most since the start of the COVID pandemic. What you see all the way on the left is social cohesion erosion. We saw that play out in South Africa in the form of the July unrest, but it also played out in the US in various ways, the form of the government insurrection, in France in terms of protests against vaccines, and in many, many other countries. We've also seen livelihood crises, climate action failure, mental health deterioration, extreme weather, debt crises, cyber security failures. So a number of them that have increased significantly. All the way on the right-hand side are a number of crises, and although they're represented in this graph as being small, it's not that they are insignificant, it's just that they haven't worsened to the same extent as the ones on the left. So we see things like geophysical disasters, terrorist attacks, etc. So what we did to try to unpack this graph a little bit more is we then went and shaded or grouped together different categories of crises that have started to unfold. In dark blue, you can see societal risks and challenges. In light blue, you can see economic risks. Orange shows the environmental risks. The peach color shows geopolitical risks. And the yellow represents technological challenges. What I find particularly interesting by this is if you look at just the top 5 on the left, the risks that have worsened the most as a result of or during the COVID period are the ones that are societal or environmental in nature. So taking these long-lasting implications into account, let us consider the state of affairs in our beloved country. Economic growth is a very important indicator of the trajectory of the country. And what you can see here on the left-hand side is from 2016 to 2019, we actually had really pedestrian growth. It was anything from 0% up to just below 2%. This makes it really difficult for us to address our social challenges as a country. In the COVID period, obviously growth got hit really hard and dropping to about 7%, and then rebounding the following year, fairly positively. The projections over the next period of time is that it is expected to lower once again. But it's interesting, we don't operate in isolation. So comparing that to various other countries, and we just included, for the purpose of our discussion, a mixed combination of some developed and developing countries, a BRICS country we included there as well. So we've got South Africa on the right-hand side compared to Australia, Brazil, Kenya, UK, and the USA. And what you can see is that with the exception of Brazil, over the pre-pandemic period, the other countries, developed and developing, had generally a higher growth rates than us. What was interesting is in 2020, we were by no means the worst hit economy. And I'll explain just now why that was. The UK, for example, had the worst impact on their growth in the last 20 odd years. They have then bounced back quite strongly in 2021. And what you can see is for the forecast period, a number of the countries are expected to have growth rates that are a bit above our level of growth. So one of the factors that's driven our growth in the last several periods is commodity, in the last couple of years is commodity prices. This has operated as a bit of a buffer to us, certainly has given us a bit of strength in terms of economic growth. So what you can see here is in the pre-pandemic period, this graph shows it's an index price with data coming from the Reserve Bank, and it shows how in 2020 the prices of these commodities, which we export, increased considerably. I think a really good news story for South Africa in 2020 was the impact of the rhodium price. And what you can see is earlier on in the graph, the earlier periods, you could barely even make out the rhodium price component to this index. But in 2020, it increased considerably. Now, it's worth noting we are the world's biggest producer of rhodium, which is really positive for us. Now, despite the fact that this has come off its highs of 2020, you can see that the commodity prices are still notably higher than they were in the pre-pandemic period. And just to pause and just recap, what we're going through now is there's about 15 factors that, and aspects of the economy that we're just going to talk through just to highlight where we are as a country. Another interesting aspect is to take note of the structure of the economy. Now, what we've done here is to look over the period 2015 to 2021. And I think it's interesting to have a look and see how have different sectors of the economy been impacted over this time. So you see electricity, gas and water, construction, agriculture, forestry and fishing, and the various different sectors. Now, it's interesting, most of the sectors got hit pretty hard in the COVID period. You'll note that it's just central government services and finance, real estate and business services that actually increased during 2020. The very interesting one for me is finance, real estate and business services. What you can see is each year it actually increased, even through the pandemic. And a big driver of that was the fact that it's largely the service-orientated part of the economy. People were able to work remotely and then continue operating. They were able to adopt digitization at a greater, faster rate to continue their working. And so, they've been able to continue to contribute positively to the economy. All this drives the wealth of the general population. Now, this is an important indicator because it shows the GDP per capita. On the left-hand side, what we can see is South Africa's GDP per capita from 2013 through to 2021 and projections for the future period. Somewhat concerning is the fact that the level of 2013 is what we were back at in 2021. And it really hasn't progressed. There were some increases and decreases over that time, but we really haven't moved much since 2013. If we look on the right-hand side, though, again, it gives us a bit of context because the trends are quite similar in a number of countries where the 2021 levels in those countries are not too different to what they were in 2014, with the exception of the US, where it's considerably higher and it has really improved. The big difference, of course, is the scale and the fact that in South Africa, our level is so much lower than in the other countries. This is driven largely as a result of unemployment. And you can see this is our horror graph, our shocking statistic. This indicates the level of unemployment from 2015 through to 2021 and projections beyond. And we have the worst official unemployment statistic in the world. Last year it got to just short of 35%, which puts a lot of pressure on the economy. Compared to other countries, you can see just how much worse it is compared to our basket of countries that we are considering and including here. This all translates into the inequality index as shown per the Gini index. Now, the Gini index, it's a measure of inequality present in a country. An ideal situation is where incomes are perfectly distributed, and the index would then show the country's value at 0, whereas 100 represents the highest inequality situation. According to the IMF, South Africa's high level of inequality is a result of unequal access to opportunities and regional disparities, low growth and rising unemployment. What's interesting is during the crisis period, the World Bank, they estimate that the Gini coefficient increases about 1.5 points in the 5-year period following major epidemics, and that they've tracked that over a number of epidemics. So while the effects of COVID-19 pandemic are still being calculated, early estimates predict, according to the World Bank, that an increase in Gini coefficient of 1.2 to 1.9 percentage points per year for 2020 and 2021, which is essentially going to continue to put considerable social pressure on the environment in South Africa and elsewhere. Let's now have a look at another important aspect of the economy, which is government spending. The graph on the left shows government spending as a percentage of GDP over the 2014 to 2021 period. You can see it's been relatively consistent as a percentage of GDP, increasing notably in 2020. Now, if we consider that compared to the other countries, it's a very similar trend in most of the other countries, where there was a big spike in government spending, and that was largely to assist with additional expenditure costs incurred during the pandemic, and really helping people survive during that crisis period. The trend is expected as a percentage of GDP to reduce. Perhaps another interesting filter through which to consider government spending is having a look at the categories of government spending over a period of time. And here I've got data grouped in 4-year periods, 2004 to 2007, and 2008 to 2011, etc. You can see that employees' costs, government salaries, for example, accounted to about 11.2% of GDP in 2004 to 2007, whereas in 2016 to 2019, it had increased considerably to 14.4%. On the other hand, capital expenditures increased, it was 2.8% of GDP in the first period. It increased a bit to 3.2% before declining. Now, why this graph is particularly concerning is it shows that there was a considerable increase in spending that did not contribute to further growth of infrastructure, etc., and support of the economy. A very important aspect is the impact of prices, or what's happened to prices. Now, I see this as a bit of a positive story for South Africa, because as we know, our inflation band is between 3% and 6%, and the Reserve Bank tries to keep inflation within that band to create certainty for business and for markets, etc. During the period 2018 through to 2022, you can see that inflation has stayed largely within the band. Even during the crisis period, it has stayed generally between the band, dropped slightly lower for a period of time, but is within the band. As we will see a little bit later, that is not the case in many other markets. And so I think a big reason why that there's been, there was success in this is the prudent approach taken by government in terms of spending and support and how they supported the economy. It was not just a big mass scale printing of money, but it was done very prudently. One of the big drivers of inflation is energy prices, and this graph here shows the ranking of South Africa's energy prices compared to other countries globally. Now, if we had a look at this graph 10 years ago, it would look quite different. But what you can see is South Africa's energy price, cost of electricity is really high, much higher than many of our other counterparts across Africa, much higher than many of our trading partners, which does put a lot of pressure on us, and we'll talk more about that a little bit later. The main measure used by the Reserve Bank to manage inflation is interest rates. What we saw, and this graph shows the prolonged period from 2005 all the way to 2021, what you can see is interest rates were quite high around the time of the global financial crisis, that period 2007, 2008, and then they came down quite considerably. Then they came down notably again during the COVID pandemic. Now, that was to support businesses. It was to try to reduce and certainly limit the number of business failures, and to really support the economy. It's certainly helped significantly, but what you can see is that the interest rates, they are still structurally quite a bit lower than they were pre-pandemic period. Interest rates have a direct impact on various parts of the real economy, and house prices is one aspect of it. What we can see here with information from the Reserve Bank is that at the start of the pandemic, there was an expectation that house prices could drop considerably. Now, that leads to an erosion in wealth in individuals, and there were three scenarios that we set out by the Reserve Bank. The blue line, the orange line, and the worst case scenario being the black line. What was interesting is what we saw actually transpire was quite different. Now, this is information taken from Lightstone Property, and they analyze house prices. On the left-hand side, we can see the annual house price growth. So what you can see is even during the course of the pandemic, it stayed positive. This is the national average. In certain regions, in certain pockets, prices increased or decreased more or less, but this is the national average. So what this shows is that there was not an erosion in the value of house prices, which is positive to individuals with homes. It also is positive to companies that are involved in the construction sector, because if there was a significant decline here, that would have had a very big negative impacts on the construction sector and companies involved in home improvements, etc. This graph is also associated with it's driven a lot by the effect of the pandemic. And what we saw in this crisis, and last year, I mean, we touched on the different crises over the last several decades, and the features of those crises and how each crisis differed. The big impact of this crisis, as we all know, there was a hard lockdown. People could not travel. People could not go to restaurants. People could not spend money on certain things. As a result, there was a big increase in levels of savings, private household savings. And what you can see is we actually had negative household savings for the period pre-pandemic, but then our savings actually became really positive. And as I say, this was because we could not spend in certain areas. This then led to people starting to spend in other areas, online shopping, online retail. And you're also starting to see now, as things open up, there's a big drive and impetus for people to go and travel a bit more, to eat out a bit more, and to spend money. And what we're seeing now is, that the expectation of savings to come down once again. It's quite similar, the trend, to what we see in many countries. The level of saving in many of these countries on the right-hand side was influenced by the approach to the pandemic by the relevant respective countries. But there was a notable global increase in savings, which then has started to come down as things have opened up. A very important consideration is the perception of risk. As we all know, businesses invest based on the perception of risk. What is it expected to be going forward? They take into account what happened in the past, but very much what's expected to be the case going forward. The government bond yield is a good indicator of expected risk, and you could see how it increased dramatically in the period 2014 onwards, and then shortly before the pandemic, it also increased. Compared to other 10-year bonds, you can see we're trending similar lines to the other emerging markets, much higher than the developed countries, which means that when there's a shock or a crisis, then our risk view and rating gets heightened considerably. What's interesting is Moody's view of our risk as a proxy, and what we could see over time, how this has trended downwards. But I would like to pause here and just note that a friend pointed out to me the other day, that the first rule of being in a challenging time or being in a hole is to stop digging. And in many ways, I do feel like we have done that. If I look at the focus of the government, yes, things are not perfect. There is a lot we need to do, but there is a lot of focus on many of the right areas. And we can see that things seem to be tapering out from a global risk perspective, and that's a really good first positive step in terms of the view of the country. This is just another interesting aspect of uncertainty, and I'm really emphasizing and highlighting uncertainty just because it's what drives investment, it's what drives job creation, it's what drives focus on building value chains, which we will get to just now. This is an interesting snapshot of history, because what it shows, all the peaks are different crises that we faced as a country over the last couple of decades. You can see that the point where one of the finance ministers was fired. You can see transitions of presidents. You can see great periods of uncertainty. What I take from this graph as a real positive is, while our level of uncertainty increased considerably more than the global average and the emerging markets average during many of the periods, it's still higher, but it has come down considerably from what it was. So, having considered all of that and the state of the economy over the last several years, let's pause and reflect on some of the major points that were mentioned by the Minister of Finance in his budget speech yesterday. So, in terms of revenue collections, we know there's been a really big focus on revenue collections. The Minister of Finance, he spoke about what they're going to be doing to increase those revenue collections. There was obviously a number of relief measures provided, which did have an impact in the last few periods on revenue collections. If we look at the fiscal deficit, that's sitting at it's estimated to be about 5.7%. We're still going to have a moderate fiscal deficit over the coming periods. I think what's positive for me is if I look at gross debt to GDP. Now, this shows what the view was in the 2021 midterm budget policy speech. The orange dots show the trajectory that we were on as a country in terms of gross debts to GDP. Now, as we know, we focus on trying to curb spending. I heard some commentators say after the budget yesterday that they wished that there was more focus on what we could do to curb public spending in particular. But I think this is a positive that the revised estimate show that the debt to GDP outlook is lower than it otherwise than it previously had been. Another interesting aspect of what was discussed and mentioned yesterday was the way that government spending will be allocated. So we know that learning and culture and education basically forms the biggest component of the government spending, social development and grants and support being the second most significant, followed by the healthcare sector. I think it's positive that if we look a few years ahead, 2021, 2022, through to 2024, 2025, how the intention is to adjust spending focus. So what we see, the expected or the projected growth is supposed to be much higher on economic development, on community development, and it comes down on the education and learning and those fronts, but it really does focus on the growth of the economy. You can see one of the blights in our budget story is obviously the debt service cost ratio, which is expected to increase by 10.7% over that period, and that really does hurt us and hold us back as a country. But having said that, if we look at the trends in tax to GDP ratios from 2002 to 2020, you can see that we've trended below the OECD average of many of the countries, but a similar sort of trend line in terms of the tax to GDP ratio. I want to talk briefly about a couple of the points that the Minister of Finance focused on particularly yesterday. So one of them was he spoke about, and Yasmeen will talk more about it just now, the increase in the tax brackets for individual taxpayer. I want to focus on the reason for this. There was an interesting study that was done called the Macroeconomic Risks After a Decade of Microeconomic Turbulence, focusing on South Africa. And what it did was it set as a base 2014 period, and then it looked at, and you can see on the right hand side the different income tax brackets, over 150,000, over 300,000, all the way to the over 2 million rand bracket. And what you can see is, compared to 2015, because we did not have significant increases in tax brackets, what it meant is that for people earning more than 150,000 rand, that lower tax bracket, the amount of additional tax that was being taken from them by 2019 was over 1%. At the higher income tax bracket of 2 million, it was an additional 2.5% more. So you can see that the reason for the Minister of Finance saying, well, let's address this, because his big focus was how do we put a bit more money into the hands of consumers. Another very interesting aspect is the factors affecting inflation. Now, on the left-hand side, you can see over a snapshot of a couple of periods, a couple of years, you can see the factors contributing to headline inflation. So there's petrol, electricity, food. Have a look at petrol, being the yellow one. You can see how the share of it in the last little while has increased. And as we know, it's a really important factor in the inflation basket. I think what's perhaps even more insightful and interesting is on the right-hand side. We've got a graph from 2009 to 2021, and we can see what the petrol price is made up of. So there's the basic fuel price, which is the cost of the fuel. Then there's the road accident fund levy, general fuel levy, transportation costs, other margins, and other levies. If we have a look at the extent to which the basic fuel price makes up this total fuel price, it's increased 100% over the period 2009 to 2021. Road accident fund levy, for example, has increased 261%. General fuel levy by 170%. So the taxes on this commodity have increased disproportionately higher than the actual underlying commodity. So as a result, I think it's a really positive thing that the Minister of Finance said that they are reviewing the factors impacting the petrol price and are putting a hold on some of these items that are making it up. But again, Yasmeen will talk more about that a bit later. So in bringing the discussion on the South African economy together, the challenges that we have in large part are the same as the challenges we had last year. We need to grow the economy. We need to create jobs, decrease debt levels, increase consumer savings, encourage FDI, increase the wealth of the population, and reduce income inequality. The question is, what's the government's approach to this, and how are we going to do this? So there were four key agenda items that were mentioned. The one is focus on energy security, which is a really critical aspect of our economy. Secondly, aligning with national development plans, infrastructure growth, promoting industrial growth, and strengthening the enabling conditions. What I would like to do is just consider where we are at this point in history. So it's positive. It's really positive that we've got these agenda items that we're working on as a country. But I think if we take stock of the fact that we are still in the midst of a crisis. Now, this graph here, this shows how there are structural changes that take place during a crisis. Now, think back to the first chart that I showed of the key risks that changed the most since the start of the pandemic. And a number of them are shot up from previously not being that significant. In other words, there are these structural changes. What you can see here is all the way back in 2002, our economy was, compared to this basket, which is a bit different, this basket of countries, Ireland, Nigeria, Singapore, Sweden, and South Africa, our GDP was basically the second highest. Even all the way in 2007, it was strong. All countries got hit by the global financial crisis in 2008 and 2009. What we saw was an initial period of strong bounce back. Commodity prices helped us during that initial period as well of growth. But then we started to have a period of decline in terms of the economic growth. At the same time, many of these other countries had a couple of them in particular. If we look at Ireland and Singapore, they had a continued long-term trajectory of growth to the point that they're practically caught up, having been quite a bit smaller than us previously. So structurally, there are changes that take place during a crisis. And the question we should ask is, what happened after the last crisis, and what can we learn from for this particular crisis? To answer that, there was a publication that came out a few weeks ago that it's referred to, was the wider working paper that's published by the United Nations University. And it had a detailed, in-depth look of the South African economy over the past decade. What I found really interesting is they looked to answer three questions. What drove our very low level of growth? Was it external narrative, so external factors impacting the economy? Was it the macroeconomic narrative, the fact that for the first several years we had a counter-cyclical policy, we tried to spend to encourage and stimulate the economy? Or was it the microeconomic narrative? They concluded after a very in-depth analysis that actually it was the microeconomic narrative that, in their views, drove the lower levels of growth. In particular, in unpacking the factors affecting the microeconomic narrative, they put it down to a formula which they say is growth is dependent on levels of employment, the capital that you invest into to the economy, and also taking into account what they call the total productivity factor. Now, what's interesting is over time, our level of capital increased, our level of employment increased, but not our employment rate, but our level, total nominal level of employment increased slightly. But what decreased was our total productivity factor. And that's depicted in the graph below, where you can see how it's come down over time. Many of the other countries, Singapore, Ireland, on the previous graph, theirs was positive during that period in time. The big drivers of this are what they call network issues. So that the fact or figures like or items like electricity and the Eskom challenges of the economy, the rail and difficulties with rail challenges, etc. And lots of those sort of items had a very big negative impact on the economy. So the question that we need to ask ourselves is, how do we take ourselves from this point in crisis, and what are those big factors? What are those big trends that are impacting us and that have structurally changed things or are changing things? How can we take advantage, or how can we avoid some of the big risks that might be coming towards us? So what I'd like to do is we've identified 6 major themes and that are likely to impact us over the next period. And we're going to open up the poll shortly, and I would like to ask you to indicate which of these trends do you expect to have the greatest impact on your business over the next 3 years. So in a moment, the poll will pop up and you'll have an opportunity to answer that. Okay, we're going to close this in 10 seconds. Okay, and hopefully we'll be able to see the results in just a moment. What's interesting about these trends is that they were actually corroborated by the World Economic Forum, who produced their outlook on 2022, and a number of these featured in their particular outlook. So if we have a look here, so 14% of respondents said climate change or the green economy, digitization was almost 30%, employment trends 10%, global competitiveness 21%, inflation 19%, focus on revenue collections 7%. Now, these are by no means the only trends, but these are ones when we look at a number of developments since the start of the pandemic and consideration of various research. These are significant ones that we've identified for business in South Africa and across the continent. So let's unpack each of these. As I say, the first one, climate change, digitization, employment trends, global competitiveness and value chains, inflation and global tax reform. So the first one is the green economy. Now, this map here shows the photovoltaic power potential in the world. And to me, this is a really exciting graph and chart because it shows our potential from a solar energy perspective. And indeed, from a renewable energy perspective, we've got a lot of potential in South Africa. This gives us the potential to reduce the current level of dependence on Eskom and the current energy supply. What is not as promising is if we look at the ranking in terms of the climate change index and the readiness of this, South Africa is relatively low in the ranking. So we have quite a lot of work to do in this regard. But I would say that, yeah, it's some of the positive developments that we have seen is that the fact that independent power producers are now able to produce considerably more. So over about up to 100 megawatts they can produce. There's a number of IPP projects that have been established, a number more in the pipeline. So really very positive. But the green economy also, there's various aspects to that, and companies that are positioning themselves in the green economy, whether it's to produce parts and components for vehicles, electric vehicles, or other parts of the economy that are moving towards going green, those sort of companies have big potential for growth. So this is a big opportunity to the extent that we're able to take advantage of it. The second trend is digitization. Now, this graph really excites me. It's research done by McKinsey, and it's various different tech trends that have been identified by them. So everything from process automation, future of connectivity, distributed infrastructure, applied artificial intelligence. Why this excites me is it gives an opportunity. It's a lot easier to access technology than it was previously. We've got smartphones. You can access smartphones. There's you're able to put together a business plan on a smartphone. You're able to create apps. We even saw during the pandemic some really phenomenal success stories where individuals in the informal settlements created apps on their phones to help with movement of goods to people who are not mobile and able to move around. So technology can be used to address social challenges. It can also be used. One of our clients that's very involved in an aspect of technology indicated how it can be used to reduce corruption by tracking supply chains and the passing on of goods and services. So a lot of tremendous potential as a result of technology. The current state where we see in terms of the digital competitiveness index is that, again, South Africa is quite far behind. We're slightly ahead of Botswana. Why this is really important is what we are seeing, and Yasmeen said at the outset, we advise clients on their value chains and on different parts of their business. And it's been interesting for me to see how businesses across all sectors have focused in the last 2 years on including an aspect of digitalization in their strategy, whether it's platforms, whether it's software solutions, whether it's for monitoring products, whether it's for adding significant value to clients, whether it's for managing risks. Across the board, there's been this growth in digitization. Now, what's really important is companies look to grow in terms of from a digital point of view, where the environment really suits them, where there's opportunity, where there's other networks that they can tie into, suppliers, other service providers, where there's good infrastructure. So it's really important that in order for us to encourage those activities in South Africa, that we improve our digital competitiveness. This graph shows it from a slightly different aspect. The left shows the level of digital development. The x-axis shows the rate of digital growth. You can see currently we're in the bottom left quadrant. So it shows we've got a lot of potential and a lot of room for growth. And the countries that have bounced back faster in the last 2 years have been those that are able to better support companies operating in the digital sector. So to me, this is a really critical aspect. I know that in terms of the government economic plan and development plan, this is an area that the president is looking into, how we support digitization in South Africa. It was also announced about a week ago that there are intentions to roll out basically free bandwidth to free data to every household across the continent. How that will be funded and the rollout, I'm not sure. But again, I see that as a really big positive. Just lastly, in terms of the international bandwidth by region, you can see Africa is really, really low. The more we were able to increase and roll out and increase the extent of bandwidth, it's going to be really tremendously positive. We're seeing some individual positive stories. For example, I saw the other day that there was a satellite that was launched that's going to help to track certain aspects of shipping and fishing across along the coastline, and technology and bandwidth being used in various different aspects of the economy is really, really very positive. This one here to me is a very interesting graph. Now, the Great Resignation describes the labor force considerations. And what we can see is after each of these big crises, there's a period of significant, initially there's a decline in resignations, followed by a period of increase in resignations. So you can see in 2001, people during a crisis tend to hold on to their jobs, but as there are structural trends, other opportunities opening up, there tends to be a bit of an increase in resignations. In November 2021, we saw a staggering statistic coming out of the US, where in that particular month, there was a total of 4.53 million resignations. Now, I think this, I saw I received a message from LinkedIn at the start of the year, and it gave me a summary of my LinkedIn profile and my network. And what was interesting is that some of the stats showed that 25% of people across LinkedIn have changed jobs since the start of the pandemic. It showed that the number of people that's and how jobs have changed, the number of people working remotely. And again, it's really significant increases. The number of people working remotely increased by about 2 times since pre-pandemic levels. So what we're seeing is structurally big changes in the in employment trends. A couple of the other interesting observations here is, and the World Economic Forum looked into this, and what they found is that currently the trend that we are seeing through surveys that they conducted with various economists around the world is that there's been with the growth in digitization, companies have moved to try to increase their digital capacity. Systems have not yet been ready and in place, so that's meant that more people have been required to try to develop those systems, and as a result, there's been a migration in the types of jobs, and that's creating really positive opportunities in the digital sector and also in the green economy, which is a big driving factor, but it's also put lots of pressure in other markets. We're also seeing, and the World Economic Forum also highlighted at this point, that there's a great competition for jobs. We're seeing it internationally as well. I think a positive that came out in this regard from the State of the Nation address 2 weeks back was the president announcing that the government needs business creates jobs. It's not the government that creates jobs. Government needs to enable the creation of jobs. Business needs to create jobs. And I found it very positive, and this statement, I'll say, it was a bit of a dividing statement. Some people liked it, other people didn't like it. Personally, I see it as a very positive because the president is looking at putting steps in place to see how we can remove certain red tape. Some of the items that have also been mentioned or implemented since the start of this year, there was the suggestion that we should create a visa for remote working. Now, Robin, will tell you about the tax complications that arise with having remote working in different countries. But the concept that we potentially are trying to encourage people to come and work from here is a positive one from an economic perspective. The critical skills list got revised. There's e-visa online applications. So a number of positive developments and employment trends. But this really is, to me, a really critical aspect. How do we go about encouraging companies to set up their operations and expand in South Africa to create the jobs? I'm just conscious of time, so we're going to just move on from that polling question onto the next trend, which is global competitiveness and value chains. Now, this has been something that's been disrupted significantly, value chains. So the World Economic Forum conducted a survey to ask business leaders their opinions on the future of global value chains. Did they expect more globalization, neutral level of globalization, or less globalization? So what you can see is many of the countries expected greater globalization. In South Africa, most respondents were either saying that there would be more or otherwise neutral. But there are various factors that affect global value chains. So a number of them that were identified by the chief economist's outlook at the World Economic Forum The first one was the initial emergency shutdown when supply chains came to a grinding halt. That had a really big impact on supply chains, and that started to work its way through the economies. But there was also a shortage of supply. You just could not get certain items. There's also been this move to companies, wanting to say, well, we've learned from our lesson at the start of the pandemic, so we're moving from just-in-time supply chains where efficiency is the biggest priority to just-in-case. So almost parallel supply chains to say, well, actually, we'd better have some buffer stock in case of need. Some countries have started to introduce protectionist measures to say, well, we want these products to be produced in our country because we don't want to have that great level of reliance. Lastly, digitization has impacted supply chains. You can monitor things, you can get more information from customers, and digitization has had a big impact. Again, people working remotely, etc. The reason why this is so critical from a job creation point of view is this graph here. And I've indicated a number of countries and a number of companies. And what you can see is, in many cases, companies, large multinationals, their revenue is higher than that of individual countries. And the other interesting thing is that these companies generally will have a faster rate of growth than many of these countries. If you just think of Apple, over the last 20 years, the rate of growth in revenue of Apple as they've launched various products has been astronomical. So the question is, how do we go about creating that environment that encourages companies to look to establish certain parts of their supply chain and value chain in South Africa? How do we create that level of competitiveness? It's positive, the development of Amazon setting up operations in South Africa, but how do we take that further? Another important consideration that will impact many businesses, and a number of you alluded to this earlier, is inflation. Just a few interesting observations here. You can actually see that the United States, their inflation is outside of their band. It's considerably higher than they had expected. It's driven largely by energy prices. You can see that the increase here, the conflict in Russia and Ukraine is also going to have an additional impact on inflation prices here. But inflation is not just a standard across all markets. In some cases, it's demand-driven inflation. In other cases, it's supply-driven inflation. Demand-driven inflation because of the additional savings that we spoke about earlier, and now people wanting to spend, and money being injected in the likes of the US market. Supply-driven inflation, driven by bottlenecks in shipping, for example, and that's creating a bit of significant challenges in a number of these markets. As I said earlier, South Africa has managed to maintain ourselves within our band overall for the past several years. This graph just shows the whole uncertainty with inflation. 2 years ago, the Federal Reserve governors, they were asked to plot where they saw inflation, and then late last year they were asked to see it. So on the left-hand side, you can see late last year where they expect inflation to be over the different, interest rates to be over the different periods. They're expecting interest rate hikes over the coming years. Whereas 2 years ago, as we can see on the right-hand side with the blue chart, even though there was lots of stimulus packages being pumped into the US economy, there was not this expectation. So in many ways, it's been very difficult to control the levels of inflation and created a challenging environment in the US. The last trend is global tax reforms. Now, we've done research to look back over the last multiple number of crises, everything from World War II, or even the Great Depression, World War II, the oil price crises, global financial crisis. After each one of these big events, there's a reform in international tax. And what this seeks to do is to, countries seek to say, well, how do we've got all this spending that we need to cover, how do we raise additional revenue collections? I've plastered on the screen a whole bunch of acronyms. Now, these are measures that are being introduced in the European Union or otherwise contemplated in the European Union, and in some cases globally, to raise additional revenue or to certainly protect economies and regions from what's regarded as base erosion. So a number of these are driven from the EU. There's the digital service tax that was implemented in a number of countries. The brakes have been put on that, hold on that for a number of countries, because the OECD, as requested by the G20, has looked into the Pillar 1 and Pillar 2, and that's the global minimum tax provisions are being looked at and considered, and lots of work being done on that. So the reason why I'm introducing this slide is just the point that there is a big focus on revenue collections. There's a big focus on transparency of value chains. We're seeing a lot more onus put on businesses to communicate, explain, highlight where they make changes in their value chains and supply chains and what the impact is, because there's greater amounts of transparency being sought. And the focus by revenue authorities on tax audits is certainly increasing and will continue to do so. So, in summary, we've considered these trends that are having a really big impact, and they will impact businesses in our country. We were in a difficult place in a country. We had low economic growth, and this was exacerbated by COVID. We've had some tailwinds through commodity prices, and we had surplus revenue collections for certain periods. But the risks arising from COVID, together with other risks present in the economy, are very challenging. We've stopped digging, if you have a look at the uncertainty index, and we are trying to repair our economy. The minister spoke about fiscal consolidation, trying to return money to people, plans to increase investment in the economy, changes to the trajectory of the public wages, public sector wages. There's acknowledgement of the critical need to grow jobs. The president and the SONA, he spoke about how he's appointed individuals to drive this process of removing red tape from the business sector. At the same time, there are a number of these global trends that we can see on the screen. The advantage is that for many of them, to the extent that our businesses are involved with digital growth, the green economy, or supporting global value chains, or taking advantage of them, the more we have opportunity for faster levels of growth. One of the big factors that inhibited our growth during the previous decade was the erosion of the total productivity factor. Digitization can indeed assist with that, and in our particular case, the focus on renewable sector energy creation can also alleviate a lot of pressure in that regard. So in conclusion, we are faced with a choice of direction. The president made it clear that that businesses create jobs, and the role of the state is to equip businesses. Overall, my view is that the Minister of Finance presented a solid budget under the circumstances. We need certainty and confidence. And looking at the response of the Rand last night to the budget speech, the initial indications of the budget speech was that it was received positively. While there are still many challenges ahead, and we are emerging out of one of the biggest crises that we've seen over the last 100 years, I firmly believe that there are opportunities ahead if we focus our efforts in the right areas and we look to build our businesses in an inclusive manner. Thank you.
Thank you, Michael. I have to say that I'm impressed by your slides. I hope the audience doesn't expect something similar from me. I'm an accountant after all. Let me get my slides up first before I continue. Right. So my job is to take you through the budget proposals related to tax. Clearly, I'm going to be looking at it from a microeconomic level, looking at the nuts and bolts of the tax proposals. And I think what would be good is if we take stock of where we are. So Michael's painted a picture for us from a macroeconomic level. There are some positives, but how do people on the ground feel? And, over the last few months, in fact, over the last year, I've been speaking to a lot of people across various spectrums, various industries, primarily of the middle class, people who are of the taxpayer class. And I can tell you that the mood on the ground isn't great. So, there are many factors related to why people don't feel great about the tax that they contribute to the economy. The first is the economic hardship that's been felt by people, particularly when all the COVID restrictions came into place. Many people had to take pay cuts, there were retrenchments, there were a lot of economic hardship, particularly for the middle class. And not to say that the low income earners didn't suffer, but the tax-paying public really did take a hit. If you look around, there's a deterioration in services, infrastructure. There seems to be a lack of services being provided by government and across all spheres of government, from local to provincial to national. One just has to drive around on our roads, look at the condition of our CBDs and so on to get a gauge of exactly what it looks like. And the picture is not really great in some of our cities. With the State Capture Commission, it laid bare the fact that a lot of our public purse funds are being wasted. If we didn't collect anymore, we could probably still deliver the same level of services with the collections that we've got. And there's a feeling, a really strong feeling amongst many taxpayers that their money is just going down the drain or being thrown into a big black hole. And, anecdotal evidence that, I've come across seems to suggest that there's a tacit tax revolt taking place. Taxpayers that I speak to are increasingly unhappy to pay the full amount of tax that's due to SARS, simply because they feel the money is being wasted. And I feel increasingly there's a bit of a disconnect between how taxpayers the budget speech afterwards, the commissioner made some comments, and some of those comments didn't go very down very well with some people. For example, one of the comments that was made after the budget speech was that SARS is a tech firm that just dabbles in tax. And that doesn't really go down well with taxpayers who really want to speak to a warm body. They don't want to be dealing with this big machine. And if any of you have ever tried to resolve a matter with SARS, it's not a quick and easy process. Recently, a journalist wrote about her personal experiences and was subject to a comment by the commissioner. And there was quite a big backlash on Twitter against the commissioner's comment that she made her private troubles, tax troubles, public. And the reason why lots of taxpayers reacted in that fashion is because that's what they experience as well. So I do feel that on the ground, there is a bit of a disconnect between how taxpayers feel, how SARS is behaving, and I think we're going to see some of that, some of the outcome, not now perhaps because it's being camouflaged by the fact that we've got good tax collections from commodity prices and so on. But I think we're going to start seeing the impact of this tacit tax revolt if we don't see any good changes coming through, not only from SARS, but from government in general. So moving on to what was expected pre-budget. So many firms put out commentary and made predictions before the budget speech, and I want to pick up a few of those. Now, there was some shock and horror stories. There was a story doing the round that that rate would increase to fund the basic income grant. Luckily, that hasn't come through in the current year, but as I will take you through later, it's still on the horizon. It's something that still could be possible. Most of the commentators predicted that there's not going to be many changes. I spoke to a few, practitioners over the last few days, and certainly the expectation was there wouldn't be any major tax rate changes. From the corporate tax point of view, it was a bit of a surprise that the tax rate reduction was actually implemented. There was a widespread expectation that it wouldn't be implemented this year. With regard to things like sin taxes, fuel levy increases, those were taken as given, and the minister proved us wrong, especially with the fuel levy increases. And specifically from the sugar industry, there was a request for no further increases to the sugar tax. And as we'll see just now, that didn't come to fruition, unfortunately. Now, one of my favorite quotes from the budget speech yesterday is, now is not the time to increase taxes and put the recovery at risk. So at least at Treasury, there is a bit of recognition that taxpayers are actually tired, that if rates go up any further, we're going to have a bit of a revolt. We saw it a few years ago when the marginal rate, the highest marginal rate was increased to 45%, and the 4.4 billion rand additional tax revenue that was expected didn't materialize. And I think increasingly taxpayers are wanting more value for money. And if there are no changes, I think we're going to see more tax avoidance and evasion coming through. Now, from a tax policy perspective, and this was in the budget review document, it wasn't necessarily in the budget speech itself. In the budget review document, what was noted is that in order to raise revenue in an equitable, efficient, and sustainable manner, firstly, we need to broaden the tax base. We need to improve administration rather than raising tax rates. However, it was noted that lowering or becoming more efficient on broadening the tax base can only take us so far. If there are permanent increases in expenditure requirements, unfortunately, what's required to actually fund that would be something significant to the tax base. And in order to raise something like 50 billion rand to fund a permanent expenditure requirement would mean that all taxpayers across all the marginal tax rates will need to increase it by 2% or have a 2% increase in VAT. Now, this is a major change. For an economy that's already struggling, inflation, yes, it's within the band, but is relatively high compared to where we were previously. And the fact that we don't have, well, most of well, I won't say most, but a good chunk of our population are not economically active and dependent on grants does hurt us quite a lot. Now, with regard to the nuts and bolts of the tax proposals, my summary of it is that it's not too bad in the short term. So the proposals this year gave some relief to taxpayers. So it's not too bad in the short term, but I think what's lurking in the future should give us some cause for concern. So what is the impact of the tax proposals this year? So overall, a tax relief of 5.2 billion rand has been proposed. There's been cuts to personal tax rates by increasing tax brackets and rebates by inflation. Inflation is considered by Treasury to be 4.5%. The last time I checked, it was closer to the 5.9% mark. But in any event, there is going to be some relief to taxpayers. And effectively, what Treasury will do is forego revenue of 13.5 billion. So the inflationary impact on tax brackets, basically, Treasury won't collect that any longer. Tax as a percentage of GDP is expected to be 24.8% next year, and this year, 24.7%. And if you remember Michael's slide earlier on, that is less than the OECD average. I think it's a bit misleading because I don't think that takes into account all the additional taxes that are paid that are not included in this headline number. Things like paying for your own private security, schooling, medical, education, things like that. Those are not factored here. A lot of the OECD countries that tax at a higher rate do provide those services to their population so that you don't have to fund that out of your own pocket. And so that's a big difference. And I think so this number is a bit of an understatement of what the true tax burden is on the population. With regard to tax buoyancy, our tax buoyancy is still over 1. And remember what this tells us. This tells us how robust our tax collections are compared to the growth rate. And as has been the case for a number of years, bar one in the last 5 years, the tax buoyancy has been over 1. So consistently, we collect more money, or the increase in tax collections is higher than the increase in the growth rate. Now, regarding personal taxes, and I'm not going to dwell on this too long because all of it, it really is just setting out the new rates that are going to apply from 2023, for the 2023 tax year. I just want to point out a few things. The first band of 18% applies to income levels up to 226,000 Rand. And your highest marginal tax rate kicks in now at 1.7, just over 1.7 million Rands a year. Now, when it comes to tax rebates and thresholds, the threshold has increased so that if you're under 65 years old, the first 91,250 Rand of income is tax-free. Obviously, the older you are, the higher rebates you have. So the threshold for over 65s and over 75s are higher as well. In terms of statistics, the interesting thing here is that although we have 15 million registered taxpayers, now remember, we're a country that's got a population of over 60 million. I think when the census is done, we probably find we're closer to 70 million Rand if they count all the people that are here illegally as well. So, that's 15 million as being the registered tax base is actually quite low. Of that 15 million registered taxpayers, only 7.5 million actually pay any tax. So the first 7.5 million actually pay, earn less than 91,000 Rand a year. Right? So 50.8% of the registered taxpayers pay no income tax. And remember, personal income tax contributes the lion's share to the budget. So, or to the revenue collections. Remember, our revenue collections are forecasted to be 1.5 billion Rand, trillion rands this year. 587 million comes from personal tax collections. So it's more than 1/3 that comes from just ordinary taxpayers. And that's only 7.5 million taxpayers, which is probably roughly 10% of the population. The taxpayers in the highest marginal tax bracket, that's only 0.87% of the total taxpayer base. They contribute 28.6% of personal taxes. And what must be remembered that these guys are the ones that are probably highly skilled, have some resources available to them, and are probably highly mobile as well. Regarding medical scheme credits, there is an inflationary adjustment, a little hors d'oeuvre to enjoy when you pay your provisional tax or your PAYE. So for both the first two members and the remaining members of the medical aid, there have been slight increases, and I think this is by inflation as well. With regard to retirement funds, there are quite a few changes that are being proposed. The most significant two that I wanted to pick up on is the cross-border tax treatment of retirement funds, particularly if you break tax residency with South Africa and which country really has a taxing right over your retirement fund. And then the two-part retirement system, they want to have reforms to allow earlier access to retirement funds. And I think this is really at the behest of the unions who are saying, well, our members can't wait until they're 65 to have access to funds which they desperately need now. And I mean, in some cases, that's fully understandable if the members are in a dire position. Over the next few months, I think we will have a lot of consultation on this issue. And then I think we will see the draft legislation coming through in the Tax Laws Amendment Bill in July. With regard to immigration, for those individuals that break tax residency with South Africa, it's been proposed that your interest and CGT annual exclusion, your interest exemption that is, and your CGT annual exclusion be apportioned when an individual ceases to be resident. So the 23,800 Rand exemption that you get every year on your interest, if you leave 2 months into the year, you'll only get 2/12 of it. Similarly, the same will apply to your CGT annual exclusion. Then one of the more significant changes is related to the disclosure of wealth. Now, currently, provisional taxpayers must complete a statement of assets and liabilities in their ITR 12 returns and declare their assets based on cost. Right? And that's relatively easy to do. However, our experience has been, and we've got quite a bit of experience in this field, many taxpayers don't populate this on their tax returns at all, even though it is required. From 2023, all provisional taxpayers with assets which have a market value of over 50 million Rand will be required to declare specified assets and liabilities at market value on the 2023 tax return. Now, that's quite a big change. Now, the reason why this has been put in place is to determine the levels and structure of wealth holdings as recommended by the Davis Tax Commission or the Davis Tax Committee. Now, while I understand why SARS will want access to this information, I think it's questionable as to how effective it will be. Firstly, I mean, how will that 50 million Rand threshold be policed? I think it's easier, it will be easy to quantify whether someone is worth over 50 million Rand if they have assets like loan accounts or cash in the bank, and you can easily calculate what the amount is. But if it's shares in private companies that they hold, it's very difficult to actually determine the value of that, especially in entrepreneurial settings where normally you would acquire those shares for a nominal amount of 100 Rand or so when the company was formed. The company may be very successful now and worth much more. Your cost was 100 Rand, but it's probably worth, I mean, how is SARS going to say, well, how much is it worth now? Similarly, for the taxpayers themselves, how would they measure market value? And we know that if you go through to valuation experts, you go to 3 valuers and they'll give you different numbers. So the question is, how is that market value going to be determined? And how much cost must a taxpayer go through in order to determine that value to disclose on the tax return? Then what is the carrot or stick to make full disclosure? So what is going to incentivize a taxpayer to make full disclosure? Bearing in mind that already a lot of provisional taxpayers don't actually disclose this information on the tax returns anyway, right? Now, the big risk is obviously that those tax returns possibly do not prescribe. So if SARS comes along in 10 or 15 years' time and wants to do an audit, they are welcome to do so, and the 3-year rule would not necessarily apply. So that's probably going to be a inhibiting factor. But taxpayers are not really too worried about it right now. What's SARS going to do to make sure that they get this information? And then lastly, most wealthy taxpayers don't own their wealth in their own names. Very few own their wealth personally. Most of it is in trusts. So to have a good measurement of wealth, actually, this exercise needs to be done for trusts as well. It can't just be done for individual taxpayers. And if this is not an incentive for wealthy guys that own their wealth in their personal capacity to do some estate planning and just divest themselves of the assets, I don't know what will be. Then regarding trusts and wealth taxes, there haven't been much changes here. In fact, on trusts, the rates remain unchanged. No amendments have come through in the budget or the budget review. CGT, estate duty, donations tax, security tax, and transfer duty all remain the same. So nothing particular on that front. In regard to employment, this is one of the big changes that came through in the budget. And really, it's to stimulate youth employment. Now, currently, 56.2% of all 20 to 29-year-olds are unemployed. Right? And the idea is to stimulate the employment of young people who have little or no experience. Now, I can see that SARS is one of those that have hopped onto this idea as well and has put out a notice that they're going to employ, it's a couple hundred matriculants, I think, to man their call centers. All I can say is that the call center needs to be manned by people who actually know something about tax. So I hope that a rigorous training program is going to be implemented before the call center staff are put in place. So regarding this particular incentive, there's going to be a 50% increase to the maximum ETI claimable per employee. So it's going to increase to 1,500 Rand per month in the first year and 715 Rand a month in the second year. Obviously, it's a calculation based on the remuneration that's paid to these employees, but the maximum benefit is now obviously much more attractive. There's an anticipation that the tax relief would amount to 2.2 billion across taxpayers, and will be effective from 1st of March 2022. Treasury is also considering incentives to support jobs for long-time unemployed work seekers. So your older people that are still looking for work, but are unable to get those jobs. And they're also looking at expanding the eligibility criteria for qualifying employees to improve the incentives for smaller businesses. So I think we'll see more changes, but probably in the amendment bill when it does come out later this year. From an admin perspective, there is a move to start imposing understatement penalties for incentives that were improperly claimed. Now, similar to VAT, this employment tax incentive, almost can give you a refund position, or it gives you a deduction of the PAYE payable. So it is a cash benefit that would benefit the employer immediately. And I think similar to VAT refunds, there has been quite a bit of abuse, claiming of ETI rate wasn't really warranted. So I think it's quite right to deter that kind of behavior. So one of the other big stories of the budget speech was the fact that last year's proposal to reduce the tax rate to 27% will come into effect, effectively for years commencing 1 April 2022. So the first taxpayers who will benefit from this reduced rate are your March year ends. So your companies like Mr. Price, TFG, Tonga Hewlett, I suppose, all of those will benefit from the reduced rate from the March 2023 year end. For those taxpayers with December year end, this will be applicable for the December 2023 year end. And for February year ends, unfortunately, the first year it will become applicable is the 2024 tax year. Now, just one thing to note from an accounting perspective, this announcement is now substantively enacted. It was accompanied by the introduction into Parliament of the Draft Rates and Monetary Laws Amendment. So this is a definite, it's coming in April. So from a deferred tax perspective, you may have to look at revaluing your deferred tax liabilities and assets, especially if your financial statements have not been finalized as yet. Now, remember the reduction of the corporate tax rate was going to be achieved neutrally by broadening the corporate tax base simultaneously. The amendments have already been drafted, and those amendments, and it's just a reminder of previous proposals, is the limitation of the utilization of assessed losses to effectively reduce or to limit the assessed losses that may be set off against the taxable income generated by a company in any particular year. Excessive interest deductions, this is for cross-border loans in terms of Section 23M, and the removal of certain incentives. Remember that the amendments for these have already been drafted. We may see some tweaking of these in the current year, but I think largely they will come into place, come into effect as is. Then one nice proposal that was made is that the R&D incentive be extended in its current form to 31st December 2023. In its current form, it was meant to come into an end in October. And I think there's a recognition that we do as a country need to innovate. So some level of R&D incentive is required. Whether it needs to be in the current form is questionable. And I think that's where the consultation with interested parties is going to happen. The extension and the potential amendments will also be included in the tax laws amendment bill later this year. Then just to unpack some of the Annexure C proposals. Now remember, Annexure C is part of the budget review document that is published at the same time the budget speech is read. And this is where sort of the devil in the detail kind of items are set out. Now I want to pick up on a few that are going to be of probably a more general application to most taxpayers. The first is related to variable remuneration. Remember, we've got Section 7B of the Act now, of the Income Tax Act, which specify that certain items of remuneration are only deductible when they're actually paid. And the change that is going to come through this year is to widen the application to include other performance-based payments. I don't know why Treasury just doesn't say, look, you can't claim a deduction for employee costs unless it's paid. Then it will make life a lot easier, and it's easier for taxpayers to determine which items that they've accrued for at the end of the year need to be added back. From a rollover relief provision point of view, again, there's going to be amendments, hopefully in favor of the taxpayer this time, and particularly Section 45 and the nil base cost rules will be amended. There's not a lot of detail in the budget review, so we're going to have to wait to see the amendment bill to see how it's going to impact, taxpayers. Then collateral arrangements and the contributed tax capital amendments, these were announced last year. Amendments were proposed, but they were put on hold. So currently, in the current year, we expect them to be revisited and then probably included in the draft bill later this year. From a debt benefit point of view, remember, when a person is forgiven of a liability, there may be a tax impact as a result thereof. These rules are also going to be amended to apply where debt is forgiven and an asset was disposed of in the current year, in the previous year at a loss. So in other words, the Treasury doesn't want taxpayers to benefit of a deduction or for expenditure they did not incur themselves. Then regarding lay-by transactions, and to be quite honest, I'm not sure how popular lay-by transactions are any longer. I suppose in certain parts of the economy they still are a factor. So the idea is to extend Section 24 debtor allowances to lay-by arrangements. Remember, Section 24 only applies, to sort of longer-term debt. So something that's still going to be outstanding for 12 months after the end of your financial year. Lay-by generally is over a few months. So there's going to be some amendments to Section 24 to allow for the seller of the goods to have some benefit because of the deferred payment arrangements. And we're going to expect some changes to government grants, for the government grants in kind to align with cash grants, because those are treated somewhat differently at the moment. Then with regard to specific taxpayers, on the insurance front, we do expect some changes to be made. It seems primarily to update the rules to refer to the right accounting statement, because we do have a new accounting statement that's going to come into place soon. With regard to collective investment schemes, there's a proposal that arose in 2018 that was put on hold, and it really relates to the frequent trading of shares undertaken by CISs, and whether that's capital or revenue in nature. That was put on hold in 2018, but will be revisited this year. A positive on the mining front is that the interaction of capital expenditure deductions to the assessors limitation rules, as well as the new rules for Section 23M, will be revisited, and the interaction between those provisions will be clarified. From a CFC perspective, there are various amendments that have been proposed, some related to insurance, some to royalties, but we'll see the detail when the legislation is published later this year. One interesting one that caught my eye relates to the TCS system abuse. Remember, TCS is your tax compliance status, and that's really important when you're tendering for work, especially in the government sector. You do need a tax clearance. And I think what SARS has detected is that taxpayers are filing nil returns in order to meet the requirement of no outstanding returns, even if they are actively trading in those years. So there's going to be probably some kind of penalties or punitive measures put in place to try and curb that behavior. From a withholding tax point of view, there's no changes. So the dividend, royalty, and interest paid to non-resident amounts or the rates remain the same. From a VAT perspective, very little. There was no rate change, thank goodness. It would have been disastrous, I think, if a rate change was implemented this year. But there are a few other proposals. One is related to Section 72 rulings, and further changes are being proposed to address issues arising from the reviews of previous rulings. So essentially what SARS has done is undertaken a review of rulings provided previously, and I think consideration is being given to actually codifying some of that in the legislation itself, rather than having rulings being issued to specific sectors of the economy. From an electronic services point of view, remember this is the one where you've got electronic services provided by foreigners, and there's a requirement that those foreigners register for VAT in South Africa. Firstly, there's regulations that will be updated for further changes. They would cagey as to what those changes are, but I suppose it must mean the widening of those regulations to apply to a few more foreign service providers. And then a good change to exclude once-off electronic service providers. So if you're providing randomly one service and it's taking you over the 1 million rand threshold in a year, there's no need to really register for VAT just because there's one contract. Then from a fuel levy point of view, and this is a good news story, and I think South Africans are suffering from, I would call it a battered wife syndrome. We rejoice when there's no increase. In fact, it would have been better if there was a decrease, but we'll take what we can get. As Michael pointed out, there's no increase to the general fuel levy or the road accident fund levy. And that to me is the big black hole of space. But there is an adjustment for the carbon tax on fuel by 1 cent a litre. And given all the other increases that we've suffered over the last few months, the 1 cent I don't think will make any difference to anyone. That would be effective on the 6th of April, when I think the price will be adjusted again for movements in the fuel price as well as the exchange rate. But if you look at the tax as a percentage of the pump price, it's still a significant portion of the pump price. So over 30% of the amount that we pay for a liter of fuel goes to the government coffers. And one has to question whether that money is being spent appropriately. The one good thing is that the fuel price is going to be reviewed. But, it's a significant contributor to our fiscus. If it is going to be reviewed and diminished in some form, we're going to have to see it coming up elsewhere. So I'm not sure exactly, whether this fuel price review will yield anything better or different. Then with regard to those taxpayers that can claim diesel refunds, there are going to be amendments to the legislation put forward this year based on industry-specific workshops held in 2021. Again, not much detail in the budget review, but something to look out for. From a carbon tax perspective, there's a few big changes that I just wanted to highlight. Firstly, the carbon tax rate has increased by 10 Rand from 134 Rand to 144 Rand, and it's applicable for the 2022 calendar year. So already it's effective. There is a commitment to increase the rate progressively to $20 per ton by the end of the first phase. And the end of the first phase has now been extended to the 31st of December, 2025. Now, obviously, depending on where our exchange rate goes, $20 per ton could be a significant amount. By the end of the second phase, which is 2030, it's proposed that $30 per ton be the price of carbon emissions. Now, the first phase of the carbon tax has been extended to 31st December 2025. And why is this significant? It's significant because it allows taxpayers to continue claiming certain tax-free allowances and continue benefiting from certain revenue recycling measures that are contained in the current carbon tax legislation. So we're not going to see too many changes to the carbon tax, the basic framework, until probably the 2025 year. There is going to be an extension to the energy efficiency incentive, and they're also going to extend the electricity price neutrality commitment. So some good news on that front. The trade exposure allowances are going to be adjusted, but only from 2023. And then one big change that's coming up in 2023, which taxpayers need to, definitely the bigger taxpayers need to be aware of, is that the 5% allowance for the carbon budget. So the fact that you participate in the carbon budget process with the Department of Environment, Forestry and Fisheries at the moment gives you an automatic 5% allowance on your carbon tax liability. That 5% allowance will fall away from the 1st of January 2023. And how they're going to enforce that you try and meet your carbon budget. Remember how that works is that the relevant taxpayer will tell DEFF that they're budgeting to emit X amount of tons for the year. And if they don't keep to that budget that has been approved by DEFF, there's going to be some punitive measures put in place. And that punitive measure is to pay 640 Rand a ton for the excess emissions, which is almost 4 times the current, or maybe even 5 times the current rate. So something to be aware of for those taxpayers that are subject to carbon tax. Then with regard to sin taxes, this was expected. There was, there were some proposals made by taxpayers that are impacted by this, that, actually Treasury should go easy. And one of the reasons for that is the widespread sort of illicit economy that's evolved around alcohol and tobacco, especially since COVID hit and the hard lockdown prohibited the sale of alcohol and tobacco. A lot of illicit producers suddenly rose in the economy and are still very active from what I can see on Twitter these days. So legitimate taxpayers that do actually abide by the rules and pay these excise duties will have to pay more. And, I think, yes, we're going to be pricing out legitimate goods versus the illegitimate economy. It's just going to be a lot more attractive to buy these illicit goods rather than buy the legitimate ones going forward. Then in terms of broadening the tax base, when it comes to vaping, there's a new excise tax rate being proposed from 2023, and it's 290 per ml of whatever vaping, I suppose, product that you use, whether it's got nicotine or not. Then other indirect taxes, plastic bag levy is going to increase by 3 cents effective from April. There's going to be increases for the motor vehicle emissions and incandescent light bulbs also from April. And then something that really hurts our local economy is the sugar tax, where especially here in KZN, despite the proposals made by the sugar industry to go easy, and actually in conflict with what was said in the SONA about encouraging growth in the sugar industry, the sugar tax is going to be increased. Now, yes, health on the one side is very important, it's true, but the reality is the tax did hurt the sugar industry. There were other factors, yes, but the sugar tax did. There's bigger consumers of sugar diversified or plan their products so they use less sugar in them going forward. And anyone who drinks a soft drink will see that the sugar content has definitely decreased and has been replaced by these artificial sweeteners. So unfortunately, something that's not really good news for our sugar producers, and I think is at odds a bit with what was mentioned in the SONA earlier this month. Treasury is also going to initiate consultations on lowering the threshold for imposition of this tax and extending the levy to fruit juices as well. So something to look forward to if you enjoy those beverages. Then from a customs duty point of view, there are some changes. One is quite positive, and that's related to the introduction of provisions to enable SARS to provide advanced tax rulings or advanced customs rulings. So we don't have something similar on the customs side as we do on the tax side at the moment. And I think this will be something good, provided that SARS gives meaningful rulings. I think it would really alleviate this whole idea of uncertainty and give taxpayers, firmer ground to stand on when it comes to the customs affairs. And then there is a requirement, the requirement to issue invoices for imports and exports. They're going to clarify what those requirements are from a customs perspective. I'm not exactly sure what that is, but I suppose that must mean some changes to the commercial invoices that are normally issued for imports and exports. Then in terms of future amendments, what's on the horizon? Firstly, the personal income tax regime for remote work. And I think this must be connected with this idea of welcoming remote workers into South Africa. I see that SAICA took it to mean remote work in the sense of home office allowances and what expenditure may be deducted from that perspective. We'll wait to see what Treasury puts out in terms of consultation documents. Then the exemption of foreign retirement benefits in the domestic legislation. And I think this really is born out of the challenges that Treasury faced when it comes to giving up taxing rights for our immigrants. So people that leave South Africa, and South Africa actually gives up taxing rights over retirement funds. This is now the other way around. We want to have taxing rights over the foreigners who move into South Africa. Then something that's a bit of a surprise, they want to re-look at depreciation and incentive allowances. So I'm not sure if there's going to be an overhaul of the various allowances, for example, 12C, 11E, all the building allowances and so on. The approach to adjusting thresholds for inflation, that's going to be revisited. And I'm not quite sure what's meant by this, but I assume it does mean the thresholds for your personal tax rates and so on. One would hope that they would take inflation into account in rebasing the base cost of CGT, base cost for CGT purposes as well. Because as it stands at the moment, we pay CGT on basically the amount by which our asset has increased because of inflation. There's going to be a review of the provisional tax system. Again, something quite new. I thought the provisional tax system was embedded and working quite well, but clearly SARS feels that maybe they need to collect money quicker. Some countries do collect or have provisional tax payments on a 4-monthly basis, and maybe to improve cash flow, that's where we're headed. I hope not, because it does mean an additional burden to taxpayers as well. And then there's going to be a review of the domestic legal framework to effect joint audits with other revenue authorities. And I think here, multinationals and high net worth individuals need to take particular care. If SARS is going to be able to, for example, conduct an audit with the UK or the US or Australia or any other country, you know, you can't, your information has to be consistent on both sides. You can't try and pull the wool over one of the revenue authorities' eyes. And then that's it for me. I'm closing off with a tongue-in-cheek joke. I believe there are some questions, and I need to read them first. Right, so there's a question on deferred tax. So I'm an accountant, but I'm not an IFRS specialist. So I suggest you do check this with either your auditors or your IFRS consultant as well. So the question is, for the revaluation of deferred tax asset, my understanding is that where the rate is substantively enacted by year end, but not yet effective, one is required to revalue the closing balance of the deferred tax on the balance sheet. The rate adjustment becomes a reconciling item on the tax rate recon. Is that correct? Yes, that's my understanding as well. That's how we've treated it previously. But I suggest you also check with your IFRS specialist. Then there was a question related to the carbon tax on fuel. Let me move to that slide. That carbon tax on fuel. The question is whether that was a typo on the slide, whether it's a 1% increase. Sorry? Or is it the date? Oh, sorry, I'm a bit outdated. I'm living 2 years in the past. Sorry about that. Right, it is April 2022. And yeah, no, it can't be effective from April 2020. And then the import levies on electric vehicles. Unfortunately, I don't have that information at the moment. I'll contact you separately to give you that information. And with that, I want to just quickly thank you all for joining us. I appreciate that you've taken time out of your busy day to join us at this event. I do hope that next year we can move to either a hybrid event or a physical event. I think the fact that we are able to reach many people is appreciated, but the fact is we do like to see people in person every now and again. I do want to just mention a few people by way of thanks. I want to thank you all for joining us today, firstly. Thanking Michael for joining us and sharing his expertise with us, and thanking our marketing, secretarial, as well as tax teams for putting this together. So I hope you all go well. I hope we'll see you soon. Do contact us if you do have any issues. Thank you and goodbye.